In private equity funds, we often come across a term called as investing period. But shouldn't a private equity fund be investing throughout its life? Hello, everybody, and welcome to this video on understanding the difference between an investing period and harvesting period in the case of private equity funds. I'm your learning partner, Sushila Hariharan, and if you're interested in a career in the fund industry, in investment banking operations, trade life cycle, and OTC derivatives, do subscribe to my YouTube channel where we provide content-centric, research-focused videos on these topics. At the very onset, I'll talk about what is the structure of a private equity fund. See, a private equity fund is a fund which is taking in capital from limited partners called as accredited investors, and the accredited investors collectively put in capital into the asset management company, and the asset management company is now going to be investing only in unlisted stocks. Okay, think about it. These are companies that are at varying stages of growth. They are not listed companies. It's not like a hedge fund. If you see how the hedge funds run, they trade literally every day. The mindset of a private equity investor is very different. They collect capital. They stay invested in the company for long periods of time. In fact, even the investors into the private equity fund have a lock-in period because they are not allowed to enter and exit or have open-ended transactions with the private equity fund. So all these things are for a reason, and that reason is when a private equity fund collects capital from the investors, it cannot deploy the entire capital on the same day, within a month, or even within 3 months. Therefore, it collects the capital from the investors in different tranches and through a staged wise capital collection strategy called as capital contribution, capital call, capital drawdown, etc. That is another video that's already been prepared. We'll discuss in this video about investing period. So once the capital is collected from the different partners, the capital is invested in the companies. Now, companies are at different stages of growth. Okay, so if a private equity fund has committed, let's say, $100 million to XYZ Limited, it's not possible that XYZ Limited uses the entire money at one shot. In fact, companies who are doing billion-dollar IPOs are also not utilizing the funds within a very, very short period of time. They're using it over a period of time because that is the nature of long-term capital. So a private equity fund, thus, when it is making investments into different unlisted companies, it makes it in different tranches, in different points of time. And then once it's made the investment, it doesn't sell off very quickly. It stays invested for a long period of time, long being almost 3 to 5 years, sometimes even 6 years. And this period in which the private equity fund stays invested in the unlisted companies is called as the harvesting period. So you have capital stages, then the investing period, and then the harvesting phase. In the harvesting phase, like a farmer who has done all the hard work of sowing the crops, tilling the soil, and waiting for the rains to come and nurturing it by applying all the necessary fertilizers, pesticides, etc., etc. Similarly, the private equity fund, along with its team of research analysts and strategists, also help this group of companies in which they have invested to grow and nurture. So while the investment comes in from a PE fund, let's say in the year 2022, the investment might come through 2022 and 2023, but the fund harvests those investments right up to 2027, 28 sometimes. And the most commonly used exit strategy for a private equity fund is to sell its stake to another company or encourage the company, if it has achieved a certain scale of operations and revenues, to do an IPO, in which case the private equity fund then can exit the investment in the private stocks. So the investing phase is the most critical phase, wherein they're researching about the company, they're learning about the market opportunities, they're trying to find out about how the company can grow in an unknown space, or perhaps in a known space, but in a fairly better technology enabled platform. And then comes the harvesting phase. I know private equity funds who have stayed invested in companies like Google and Meta for almost 6 to 7 years before they have exited the investment. So the capital has taken place sometime in 2004 in the case of Meta, but they waited right up till 2008 before Facebook came out with an IPO. So private equity investors, thus, the fund itself collects capital in stages, it invests the capital in stages, and it harvests the capital. And like a patient farmer who waits almost a decade or so before the mango tree gives yummy mangoes, the private equity fund also stays invested during the harvesting period so that they can get a good valuation at the time of exiting. So the harvesting period is a period of patience, it's a period of tolerance, it's a period of anxiety, because the company is using the private equity fund's capital to grow its business, and that should be done with technical precision. Thank you so much for watching this video, and if you like the content, do let your friends and colleagues know about the kind of topics that you're dealing with, especially in the fund industry as well as in the case of investment banking operations. Thank you so much.